Good morning. Welcome to Morning Call. Global markets are quiet, but this morning there is some local disquiet once again. The Reserve Bank of India fired a few bullets to save the rupee a few days back, and it was up to it again last evening. And that means bad things for growth and for bond yields this morning, though it will probably manage to give some more support to the rupee in the near term. But that's the key thing which the market and the beleaguered banking sector will be focusing on as trade opens in the next 1 hour. Mitali, hi, good morning.
Hi Udayan, good morning. Uncomfortable feeling also because, it's obviously that the Reserve Bank has understood the previous set of measures didn't work as much as they expected. So the Reserve Bank is moving in one direction.
It is, and it may continue to if the rupee does not pull back very significantly, and that's the fear. As we were discussing when the first measures came in, the RBI has taken a call, whether in sync with the government or not, that it will defend the rupee now, and that is its number one agenda, and growth can go for a toss. I think we are probably in that dangerous kind of cusp. Time will tell if this is going to be an expensive policy mistake that we are making, because while what the Reserve Bank is doing, and the market will understand that the bank will come in repeatedly now to protect the rupee around that 60 level, and that's the only upshot of what's been done. I think as we get closer to the end of the year, maybe roll forward another quarter, it may begin to dawn on people and the central bank that we may be looking at a sub 5.5% growth number for this year as well, and not the 6% number that the finance minister is talking about. So I hope it does not turn out to be a very expensive sacrifice. The only silver lining is that this time the growth problem has not been about interest rates. I mean, at best it has played a peripheral role, which is why the big cutting of interest rates which preceded these hardening moves had no impact at all in reviving growth. And therefore, the optimists might argue that any kind of clamping measure on the interest rate will also not hurt growth beyond a point, because that's not what this growth problem is all about. So if you're charitable, you would think like that, but I think it would still cause a lot of consternation in the system, which is already clutching at straws to see some signs of growth, and these measures cannot help on the margin with that.
Also, what kind of turning point for the system these events have taken, Udayan? I mean, what happened yesterday is tantamount to a 50 bips CRR hike minus the damage on banks' margins, I guess. So the whole environment has changed, for someone sitting outside looking at this country. There's a complete reset in the dynamics of it.
That is true, and one of the pillars of the market has gone taken away. This expectation that we'll be playing with much better interest rates as a regime over the next 6 to 12 months, and that at least will have a supportive wind towards equities. I think that part of the story has changed quite completely. The fact that we're repeatedly seeing the bond yield, benchmark bond yield, trade above 8%, will probably go very close to 8.25 very soon the way things are going. That's not supportive and cannot be supportive, not just for banking and NBFC stocks, but also to the market at large. We have been in a very precarious growth position. This is not going to help on the margin. Last week every banker was telling us this is just temporary, it will be taken away. And 1 week later, what the RBI has done is tighten the screws some more. So depends on how long this holds out, because my sense is that this will be in place, or any relaxation that you're talking about with these measures only happens if the rupee firmly gets stuck or anchored around 58 to the dollar. If the rupee, for whatever reason, the dollar strengthening once again, or some risk off in the global environment, starts edging towards 60, there is no way these moves are going to be unwound. So how much time this takes is also dependent on some external factors. So it's a big risk, calculated one maybe from the Reserve Bank's perspective, that they are taking. One can only hope that this will rein in the rupee a little bit, because if it does not, there might be more unpalatable measures for growth which will come in the weeks ahead.
Watch for the bond market as well. 8.5% again on the yield can't be ruled out. But just on the currency, then I think everybody needs to sit down and take a long, hard thought about what's happened with the rupee. I mean, frankly, since the last month, the rupee has actually ignored any weakness that's come through on the dollar index. It's had no impact on us. We are weaker today than we were the day the first set of Reserve Bank measures were allowed. And most anyone on the street, and I guess, a consensus opinion also counts, is actually pointing to a weaker rupee by the end of the year. So no one expects to see any big pullback in terms of the currency.
Which frankly makes me worried, Mithali. This kind of commentary which is coming in from everyone, the fact that the rupee is not recovering, you might just get a far more mulish kind of stance from the Reserve Bank. I mean, it's almost like I will teach you a lesson kind of a stance. So I hope they do not go to that other extreme by being provoked by the market to come out with sterner measures to tighten liquidity further so that they get the rupee, yank the rupee back up to that 58 plus, sub 58 kind of levels. It's a difficult job to fight the central bank, as we all know. And if market participants keep testing the Reserve Bank as they have over the last 10 days, I worry that we'll end up making some serious policy mistakes out there. So this morning I pray that the rupee does do the desired number that the Reserve Bank is hoping for, which is going to 58. At least we'll be spared some sterner measures from the Reserve Bank in the days to come. It's possible, Mithali, that the rupee settles in a 58-60 kind of zone even for the next few months, because what market participants also realize right now is that the Reserve Bank is not just firing one bullet. It is repeatedly coming in with firing one by one the bullets in its gun, and therefore market participants also will be a bit leery, I think, right now of trying to test the Reserve Bank beyond a point by taking very aggressive positions. So what this may do is to ensure that, say, over the next 3 months or so, the rupee does settle in a 58-60 kind of zone. But eventually, after 3 months, I think the Reserve Bank might also realize that what they have done is at the price of getting down GDP growth maybe by 0.5% plus, at which point they might relent on these measures, and then the weakness in the rupee will start once again, maybe coinciding with some more upward spike in the dollar. So medium term, we are not done with the rupee's weakness, I think. I think for the short term, we might be done, but probably at a price which is going to be quite expensive for the economy.
Yeah, I think that's the most disturbing takeaway, what's happened to growth targets and how that's getting slashed over the next few quarters. But quick word on the equity market. It's a bit of a sideshow today, Udayan, and we're sort of wrapping up a series which looks great, as a headline for the Nifty, but has been quite unexceptional otherwise.
Well, tomorrow's expiry, Mithali, so what can one say about the market? You've seen how markets tend to move around the expiry, so it'll do its own jig. But, I mean, if you just go back 10 days and ask yourself whether the environment for equities has got better over the last 10 days or worse, I think from an India perspective, we would have to say that the landscape has probably turned worse with the way these tightening moves have come in, a couple of these results, some of the macro data points. So we live in very challenging times. Stock markets, they're excitable beasts, so they keep moving up and down with no real correlation sometimes with what's going on underneath.